So welcome to this video. In this we are going to discuss about the topic budget. The name of the company is Mantis Gear, and this question has appeared in December 2015 examination of ACCA. So we'll start from the required. So required is A. It is clear that the business controller and sales manager have different opinions about the current performance of the company. Analyze the data shown in table 1, suggesting possible reasons why performance may not be as positive as that portrayed by the sales manager. So this carries around some 15 marks. So we have to generate at least 15 points for this question. So there seems to be a difference of opinion between the business controller and the sales manager, and this is and a detailed analysis of this has been shown in table 1. So we have to find out why their viewpoints are differing, and we have to analyze the data, suggesting as to why the sales manager is saying as a positive picture and why the business controller is saying it in a negative tone. So that is about the case. We have to just analyze and clarify as to who is right. This is a very small case here, so there's no point to be marked. We'll just go through the case and we'll gather as many as points as possible so that it's easier to analyze the case. So Mantis Gear was formed 50 years ago to manufacture branded electrical and electronic goods for other companies. These goods are made to the specification required by these companies, whose brand logos are attached to the product during the production process. M&G currently manufactures hundreds of products, although some are very similar in specification with slight differences due to the requirements of each customer. So what happens is Mantis Gear is something like an outsourced manufacturing company. They manufacture the products according to the specifications of other companies and just give the products to them. So the other companies attach their logos and they sell in the market. So M&G can produce a large number of products, something like hundreds of products they can produce. But what happens is, even though they can produce hundreds of products, these products are like very similar to each other in terms of the specification, with only like slight difference to the they make slight difference to the product and give it to the customer. M&G does not sell its own products to individual domestic consumers. Sales teams therefore focus on high volume sales to large companies. So it's not about selling each and every unit, it's about selling in bulk. The electrical and electronic goods market is increasingly competitive, with overseas companies entering the market. So the market seems to be like very competitive in nature, and the competition is expected to only increase in future. M&G's customers have responded to this by demanding lower prices and better quality products. So the price has to be like lower in order to compete with the overseas companies also, and the quality also have to be much more better. As the electrical and electronic goods market is technologically innovative, there is also a requirement to continually develop new products or enhance existing ones. So there is always a constant demand to keep on reinvesting the money into the business. The sales manager, James Slater, has revealed his sales team figures for 2014 and is excited to announce that the team has exceeded the sales volume targets. However, his enthusiasm is not shared by the business controller, Farzan Khan, who has written a report to the CEO suggesting that there are fundamental performance problems in the company. An extract of her report is given below. So this is the clash between the business controller and the sales manager. In a period of increased competition and growing product ranges, we are failing to keep control of the profitability of our products. So table 1 is showing the summary of 2014, which also shows the price, the cost control and the profitability, how it has been affected. James Slater has seen the report and has angrily confronted Farzana. We are in a period of increased competition and have successfully managed to grow our sales in difficult times. We even managed to fulfill some special orders with very short lead times. We should be celebrating these success, not treating them as poor performance. So this is what the viewpoint of the marketing manager. But the controller's view is, we are failing to keep control of the profitability of our business. So this is the clash between the two people. The sales manager says we have achieved our sales target, but the business controller says that the profitability has suffered. So who is right? We'll start from these numbers. So the numbers which are given are sales volume, revenue, material, labor, fixed overheads, and profit. So first we will check with who's right here. So the sales revenue, the sales manager says we have achieved the revenue. Has he achieved? Yes. In order of sales revenue budgeted was 36,450 and he has achieved 36,450. So he has achieved and he is claiming that he is right. But the business controller says that the profitability has fallen. So is it right? 9,000 is the profitability which is budgeted and actual profit is 1645, which has terribly gone wrong, which has fallen hugely. So it has missed the mark of operating profit by a huge margin. So here we have the budget column and the actual column. We shouldn't be comparing the budget with the actual. We should actually compare the actual with the flexible budgeting. So flexible budgeting is a control tool. So if we use control tool like this is what we could get. For example, so if the company has sold 2,70,000 units, then the income that should have been generated is 40,170, but the actual sold is 36,450. So why is the difference here? The difference here is because the sales manager has boosted up the sales volume by reducing the selling price per unit. So he has reduced by around some 10%. So that is the reason why it has fallen from 40,000 to 36,000. So number one, he has sold at a lower price. So that is itself is a kind of a problem. And what happened in terms of material? See, the material cost should have been 17,547, but it has increased to 18,630. So the adverse variance is 1,080. So why has this number occurred? See, it might have been because of this. We are in a period of increased competition and have successfully managed to grow our sales in difficult times. We even managed to fulfill some special orders with very short lead times. So there would have been like excessive usage of machinery, or the raw materials would have been bought at a very high rate, or the purchase of emergency raw materials would have been at a high price. So because of these reasons, the adverse variance has occurred. The next one is labor. Labor variance is in terms of it should have been 3,780 for 27,000 units, but it has been 4,025. So there's an adverse variance of 945. So why again this has occurred? This has occurred because there might have been a higher usage of laborers in terms of overtime. So because to fulfill the very short lead times, overtime might have been used. So that has caused the increase in adverse variance. And the last one is the fixed overhead variance. Fixed overhead variance should have been 9,000, but it is 11,450. So this would have occurred in terms of additional fixed overheads which would have been incurred in terms of using machinery heavily, in terms of depreciation, in terms of any other additional fixed cost it could have occurred. So either way, the profit that should have been even for 27,000 should have normally been 5,956, but the profit is only 1,645. So thereby leading to a variance of 4,300 lower. So when compared to the budgeted profit, the actual profit is still very low, and the business manager is the person, the sales manager is the person who has to explain as to why this kind of loss has occurred. So when we compare who is right, the business controller Farzana seems to be giving a right argument, and the sales manager, even though we can say that he has honestly worked, but he has reduced the price and he has created a lot of additional costs in terms of material, labor and overheads. So at one point of time we have to also consider that the environment has been like very tough, and it's very difficult to operate. But at the same time, the sales manager should not be expecting any kind of bonus or any incentives, and the company is certainly not in a celebratory position. Okay, so how much marks would be getting? See, the suggested marks is around some 15. So this is a very small case, and there is no kind of position in which we can add any new textbook knowledge to this question, because the question is like very confined, it's very tight, we can't write any creative answers and all. So at one point of time what happens is like we don't have much points to write. So how much marks or how much points we could generate is, we could have generated 1 2 3 4, and in case if you want this another 5, we have generated 5 points. Somewhere we could have, we have coupled the statements and the numbers. So we have coupled the numbers like special order, how it affected the material, that can be sixth one. The very short lead times, that could have been the seventh point, leading to the direct labor and overtime. So this could have been 7 points, but still, or we could draw points from here. For example, the sales manager tried to push more of high volumes to large companies but at a reduced price, so that can be like 8. And there's not much, and it also tells about the environment. As the environment by itself is tough, there's no other way to improve sales rather than to reduce it, because the customers are wanting a lower price and a better quality. So that can be 9. So somewhere we can push maximum to 10 points, but 15 seems to be a far reach. Each point we discovered, if they give 2 marks, I think we would comfortably get 14 marks here. So it depends upon the mark allocation of ACCA only. So thank you very much for watching this video. We'll meet in the next video.